Welcome to our LSR Weekly. Our preliminary estimate of Chinese GDP shows that growth stabilized in Q2 at 6%. Growth was driven by net trade, while domestic demand has weakened. SOE investment was the main driver in Q1, but lost steam in Q2. More worryingly, despite the improvement in profits, private investment growth continued to fall. With capacity still in huge excess, the multiplier effect of stimulus is greatly diminishing. Nevertheless, there are a few bright spots. Firstly, export volume has trended upwards since the middle of 2015. The improvement can be explained by the currency depreciation over the past 14 months. Since the PBOC announced its new regime to target a stable FX against a basket of currencies, the yuan has taken the advantage of yen and euro strength. The currency has depreciated on a trade-weighted basis, but remained broadly stable against the dollar. As the Chinese mainly borrow in dollars and have already reduced a good amount of their foreign currency debt, capital outflows pressures have eased, making the authorities less concerned about letting the currency slide. As long as global demand holds up well against the uncertainty related to Brexit, a weaker yuan should help Chinese exports. Secondly, consumer spending has so far been resilient. Our labor market condition index suggests that overall conditions were broadly stable this year. Besides, a structural trend that appears to be taking place is the fall in rural household savings rate. Structural policies to reduce precautionary savings could further unleash the potential of rural consumers. China's overinvestment problem is widely acknowledged by policymakers, but that problem is getting increasingly close to the point of no return. Better net trade and relatively resilient consumer demand could help cushion the slowdown in investment. But if policymakers turn back on reforms, it will soon fall into that deflationary trap like Japan did 2 decades ago. That's all from me. Thanks for watching and see you next week.